So if the US stock market feels kind of quiet to you right now, well, you're probably missing the real story. Today, we're going to break down what's actually happening just beneath Wall Street's surface. The data, the money flow, and the risks that most investors are just completely ignoring. And this quote, it really gets to the heart of it. It's a powerful reminder that the biggest risks, they aren't always in the headlines with all those flashing red tickers. No, they often build up silently under a surface that looks totally stable, which is exactly what the data is telling us is happening right now. All right, so let's dive into the first big issue here. This massive disconnect between how the market looks on the evening news and what's actually powering it. It's really a tale of two very, very different markets. This right here captures the key contrast perfectly. See, on one hand, you've got the major indices like the S&P 500, and they look strong, right? But under that surface, the number of stocks actually participating in that rise is shrinking. A tiny group of stocks is doing all of the heavy lifting. And this is a really crucial difference. A healthy market, it's like a rising tide that lifts all the boats. But what we're seeing now, it's more like a geyser. Just this narrow, powerful surge driven by a handful of megacap names like Apple, Microsoft, and NVIDIA. And when leadership gets this narrow, risks doesn't just disappear, it concentrates. And look, this narrow leadership, it actually snowballs into an even bigger problem. This concentration isn't just some interesting factoid. It creates a very specific kind of danger. The danger that happens when everyone crowds into the exact same handful of companies. You know their names, of course. Wall Street calls them the Magnificent Seven. And listen, these are fantastic companies, real profits, global dominance. There is absolutely no denying that. But their very success is what creates this unique and kind of tricky market dynamic. I mean, think about this analogy for a second. If everyone is packed into the same room and the fire alarm suddenly goes off, that doorway, it starts to feel very, very small, doesn't it? Well, it's the exact same thing with stocks. Concentration feels safe and smart right up until the moment it isn't. And trust me, history is filled with examples of this exact pattern. And this is where you find the real pressure point. The expectations that are baked into these stock prices have gotten way ahead of corporate reality. So while prices have absolutely soared, the actual earnings growth is, well, it's a lot more modest. And companies themselves are warning about tighter margins and a cautious future. And then you've got the Federal Reserve. You see, the market has been betting on these fast and easy rate cuts. But the Fed, they're looking at a completely different reality. Inflation isn't just falling in a neat, straight line. The job market is still surprisingly strong, and financial conditions have already loosened up a ton. So they have very little reason to rush. So here's the thing you've got to remember. The Fed's job isn't to prop up the stock market. Its real mandate is to control inflation and maintain stability. And what does that mean? It means restraining excess, not fueling a party. The cavalry isn't necessarily coming to the rescue if things get a little rocky. Okay, so given all these underlying risks, you've got stretched valuations and a really cautious Fed. What are the most experienced investors, the big institutional players, actually doing with their money? This is where we shift from the problem to the playbook. This is the key question, right? Because while a lot of retail investors are out there chasing momentum in those few big names, the institutional money, the so-called smart money, is doing something much quieter and you could argue much smarter. They're preparing, not panicking. And this right here, this is their playbook. We're seeing a really clear rotation of capital. Money is moving into the safety of short-term government bonds. It's adding selective exposure to energy, which can do pretty well in an inflationary environment. It's investing in real assets like industrial infrastructure. And it's focusing on defensive stocks that just generate consistent cash flow. And let's be really clear about the motivation here. This isn't about being scared and selling everything. This is about discipline. It's about recognizing the current market environment for what it is and strategically positioning for what might come next based on historical patterns. This is just experience and action. So this all brings us to the final and maybe most important piece of the puzzle. Because in a market like this one, opportunity doesn't just disappear. It just shifts. It moves to different places, often hiding in plain sight. So where is that disciplined capital actually going? Well, it's not always chasing the flashiest headlines. It's going into the picks and shovels of the AI revolution, the actual infrastructure. It's looking at sectors with long-term government contracts, like defense and aerospace. And it's finding stability in places like healthcare services and good old-fashioned dividend-paying value stocks. And here's a principle that's just so important to remember. The next market winners might not look all that exciting right now. In fact, they might even look kind of boring. But their performance over time is what's going to prove their worth. Disciplined money often wins by being patient in these less crowded areas. So what does this all boil down to? It means we're in what you'd call a selection market. This is an environment where just buying the whole market index might not work like it used to. It's a time where careful choice gets rewarded. And those broad, careless bets, well, they can get you into a lot of trouble. And that, right there, is the ultimate truth of where we stand today. This is not the kind of broad, roaring bull market where everything just goes up together. It's a lot more nuanced and, frankly, a lot more challenging than that. Which, of course, brings us right back to where we started. The surface of the market looks calm, and that is precisely why it demands our respect. So the big question to leave you with is this. Are you looking beneath that calm surface and positioning for the market we actually have, not just the one you wish we had?